What if Ethereum's biggest price catalyst is not coming from retail investors at all? What if the real driver of Ethereum 2025 is not hype, not speculation, not NFTs, or meme coins? What if the real force behind Ethereum's rise to $7,000 is already in motion, and it is institutional capital locking into place? That is the setup we are facing right now. And by the end of this video, you will understand why Ethereum may be standing at the center of the largest coordinated capital rotation in crypto history. Let's break it down. We start with the macro landscape of 2025. Bitcoin ETFs are live across the United States and Europe. Ethereum ETFs are no longer theory. They are already listed in major brokerages. U.S. monetary policy has shifted from restrictive to supportive. The Federal Reserve has cut rates twice this year, with guidance for more easing ahead. Liquidity is flowing back into risk markets. And that liquidity is not chasing meme coins. It is flowing toward infrastructure. This is the era of regulated crypto access products, exchange-traded funds, custodial products for pension funds, derivatives with approved clearinghouses. And in this new environment, the conversation has shifted. It is no longer, will crypto survive? It is, which blockchain infrastructure will dominate as institutions scale exposure? And in that framing, Ethereum is not hype. Ethereum is policy-aligned infrastructure. But here is where it gets interesting. Ethereum 2025 is not the same Ethereum of 2021. The narrative back then was DeFi summer, NFTs, and speculation. Today, Ethereum is being reframed as the global settlement layer for tokenized assets. It is no longer about JPEGs. It is about treasury bills. It is about corporate bonds. It is about the Genius Act in the United States, legislation designed to accelerate blockchain adoption across financial institutions. Ethereum is not just a chain for developers anymore. It is becoming the platform banks, asset managers, and sovereign funds quietly rely on. That is why ETF flows matter. That is why treasury allocation signals matter. That is why corporate adoption matters. And that is why Ethereum at 7,000 is not just a retail dream. It is a logical step in institutional positioning. Now here is the twist. Most investors still think about Ethereum in old terms. They focus on gas fees, congestion, or narratives from years ago. They forget what has changed. Ethereum has already transitioned to proof of stake. It has already introduced EIP 4844, unlocking proto-danksharding and lowering costs for rollups. It is already hosting entire Layer 2 ecosystems. Arbitrum, Optimism, Base, ZK Sync. These are not experiments anymore. They are scaling environments processing millions of transactions per day. In other words, Ethereum is no longer a bottleneck. It is a backbone. And when institutions look at crypto infrastructure in 2025, that distinction is critical. Let us talk about smart money signals. BlackRock filed the first Ethereum ETF alongside its Bitcoin product. Fidelity, Invesco, and Franklin Templeton have followed. ETF approval flows are not just symbolic. They are conduits for billions of dollars in retirement accounts, pension systems, and sovereign funds. Reports from custodians show that Ethereum ETFs have already attracted several $billion within the first quarter of launch. But ETFs are just the surface. Look deeper and you see a second layer. Corporate treasuries are beginning to diversify into Ethereum exposure. Not for speculation, for staking yield, for treasury diversification, for hedging against dollar debasement. And that demand does not come from retail investors buying on exchanges. It comes from custodial services integrating Ethereum directly into balance sheet strategies. Now add venture capital to the mix. These firms are quietly doubling down on Ethereum scaling startups. Rollup infrastructure, developer tooling, real-world asset tokenization platforms. This is where the asymmetric signal lies. Ethereum is not being abandoned by smart money. It is being embedded into the institutional stack. And that changes everything. But let's stay grounded. Ethereum is not risk-free. Tokenomics still matter. Over 19% of Ethereum supply is currently staked. Staking yields are hovering between 3 to 5% annually. That creates both stability and concentration risks. Large staking pools like Lido still control significant portions of validator power. This raises questions about decentralization. Gas fees, while lower on rollups, are not eliminated. And if Layer 2 solutions fail to sustain adoption, congestion could return. Regulatory clarity is advancing, but not complete. Some jurisdictions may still label staking rewards as securities. And competition is very real. Solana continues to dominate high-frequency applications. Avalanche is aggressively positioning for tokenized assets. Cosmos ecosystems are building sovereign modularity. Ethereum does not operate in a vacuum. If it stumbles, the market will rotate elsewhere. That is why investors must frame Ethereum not as a guaranteed outcome, but as a strategic probability. So let's map the bull case versus the bear case. The bull case is clear. ETF inflows accelerate. Institutions diversify into Ethereum for both staking yield and tokenized asset settlement. Layer 2 scaling absorbs retail usage, while the base chain secures high-value transactions. Real-world assets expand on Ethereum rails. The Genius Act catalyzes U.S. financial institutions to adopt blockchain infrastructure faster than expected. In this scenario, Ethereum 7000 is not only possible, it is probable. Now the bear case. If ETF flows underperform, if regulators constrain staking, if rollups fragment liquidity, Ethereum adoption could stall. A failure in major Layer 2s or a competitor like Solana securing more enterprise deals could slow momentum. In this scenario, Ethereum could remain range-bound below 5,000. Both outcomes are possible. But the strategic bet many institutions are making is that Ethereum represents asymmetric upside with capped downside. That is why flows are building. That is why developers remain committed. That is why Ethereum 2025 is being positioned as infrastructure, not speculation. Now here is the market detail most investors miss. Ethereum's roadmap is not static. In 2025, Ethereum is moving into full danksharding phases. This is designed to expand throughput capacity by orders of magnitude, bringing transaction costs close to negligible. Rollup-centric scaling will make Ethereum the settlement layer, while Layer 2s capture end-user activity. And this modular approach aligns perfectly with institutional adoption. Why? Because banks do not want unpredictable fees. They want certainty. They want settlement finality. They want compliance-ready infrastructure. Ethereum's roadmap is delivering exactly that. Beyond scaling, Ethereum is also the leading chain for real-world asset tokenization. JP Morgan's Onyx network. Franklin Templeton's tokenized money market funds. European investment banks piloting tokenized bonds. Most of these programs are not building on Solana. They are building on Ethereum or its rollups. This is a signal investors cannot ignore. If you value deep research like this, subscribe to Crypto Wayfarer, because this next section is critical. Community and governance. Ethereum's health has always been measured not just in price, but in participation. And in 2025, developer activity remains unmatched. Over 7,000 active developers contribute to Ethereum ecosystems monthly. DAO participation is rising. Recent EIP votes, like EIP 7002 for validator exits, and discussions around protocol-based staking pools, show governance remains decentralized and evolving. The Ethereum Foundation continues to fund long-term research, from zero-knowledge cryptography to account abstraction. This is not a stagnant ecosystem. It is a constantly upgrading one. And for institutions, that level of developer resilience is a moat. If you are allocating billions into infrastructure, you want the chain least likely to disappear. Ethereum is proving that consistency. So let us zoom out. The macro backdrop supports risk assets. Monetary easing is here. ETF flows are driving credibility. Ethereum's roadmap is solving scalability. Developers remain committed. Institutions are positioning. The risks are real, but the asymmetry is powerful. At this point, the question is not whether Ethereum is relevant. It is whether you understand what role it is about to play. Ethereum is no longer just another blockchain. It is infrastructure. It is settlement. It is the digital backbone for tokenized finance. And in 2025, that is exactly where the serious money is going. So is 7,000 possible? Yes. If capital rotation continues, if ETF flows scale, and if the roadmap delivers, Ethereum could become the most strategically aligned asset of this cycle. Not hype, not noise. Infrastructure. Stay sharp. Stay strategic. And keep wayfaring.